don't remember, but
So we start accounting. We're going to do question 1 to 20.
yeah.
Paper 1, May, June 2021. Question 1. It said, which statements about bookkeeping and accounting are correct? Accounting is performed periodically rather than daily, yes. Accounting relies on having accurate bookkeeping records, which is part of it. Bookkeeping includes the preparation of financial statement. You know, I told you yesterday that when it becomes financial statement, it is more of accounting. It's not more bookkeeping. So that is accounting. So bookkeeping is not about financial statements. It keeps records. As soon as we prepare a financial statement, it is no more bookkeeping. It becomes financial accounting. So 3 is not part of it.
Yeah.
Bookkeeping involves the recording of financial transactions. Yes. So it is 1, 2, and 4. So the question 1 answer is A. Clear, right?
Yes.
Question 2. What increases owner's capital? For owner's capital, I wrote owner's capital could be any resources which the owner owns and is given to the business. So we call it capital because it belongs to the owner of the business, but the owner of the business has given it to the business. So the business is owing the owner of the business.
Yes.
So an example of this is the transfer of vehicle to business from private use. So it's the owner's business. It's the owner's car or vehicle. Now it has given it to the business. So because of the principle of entity, it will be considered as capital. Clear?
Yes.
So the answer is D. Question 3. William paid $500 in cash to Sonia for rent. How did Sonia record this? This is Sonia's account. So Sonia's cash account will be debited, and William, who is the tenant, will be credited. This is Sonia's account. You did that same in the last one.
Yes.
So this is not William's account. William's account, cash will be credited.
That's Sonia.
Sonia will be trade receivable, rent payable.
Not receivable.
Will be debited.
Yes.
But here it is Sonia's account. So William is the rent receivable here. Sonia's account cash will be debited. Is it clear?
Yes.
So question 3 is A. Question 4. Apple buys all his machinery on credit. He provided the following information: machinery at cost, amount owing to suppliers of machinery. So at April 30th of April, the cost is 30,000. 90,000 was paid. So 11,000 was owed. So the payment, 90,000 was owed to supplier.
Yeah.
So he's owing suppliers 19,000. That means the first payment was 11,000. That is what it means.
Yeah.
Then another payment was made for 25,000 for the other equipment. So the total payment was 36,000. So 36,000 minus 42,000 gives you 6,000.
Yeah.
Is it clear?
Yes.
So question 4 is A. Question 5. Schuler's financial year ends on 31st of March. On 1 April 2021, there was a credit balance of $100 on Yasmin's account in Schuler's purchase ledger. So the balance carried down is $100. So Yasmin is a credit supplier. So that means Shola owed Yasmin $100. Is it clear? So the answer is B. Question 6. Asina buys radios from Nazneen at a list price of $10 each. Asina bought 12 radios and was offered $20 trade discount and 4% cash discount. 2 radios were faulty and were returned to Nazneen. That means there's a credit note issued by Nazneen, who is the credit supplier. So what was the total of the credit note issued? So 20% will be taken away from the return outward. Purchase return outward is return outward, right?
Yes.
So 20% will be taken from the return outward, right? That is 20% of $20, which is 4. So 4 minus 20 is 20 minus 4 is $16. You won't be getting cash discount because it was not about payment. The payment was not done yet. Payment cash discount will come when you pay your invoice, but the invoice has not been paid yet. So the cash discount is there, but it's not going to be. It does not going to reflect right now until you make your payment before the due date. Is it clear?
Yes.
So that's question 6. We go to question 7. It's B. Okay. Question 7. Jamil sold goods on credit. Where did he first record the invoice he used? This is a sales journal. And remember, a sales journal how do you record your sales journal? You will record in your sales journal through the source document, which is an invoice. So as soon as an invoice is issued, the first entry, the first book of original entry will be the journal, the sales journal. So as soon as the sales journal is open, the total of that journal, of sales journal, goes to your sales ledger. Then you open each nominal ledger for different accounts.
Yes.
Is it clear?
Yes.
So the answer is C, sales journal. Question 8. Which statement about a 3-column cash book are correct? It contains ledger account for bank and cash. Yes, we have bank account, we have cash account. Then they said it contains ledger account for discount allowed and received. No, it has the column for discount allowed and discount received.
Yeah.
So 2 is not part of it. And 3, it records transactions before they are recorded in the ledgers. Yes. So the answer is 1 and 3, which is B. Clear? Yes. Question 9. Which statement is not true about a trial balance? A trial balance is a list of ledger account balances at a certain date. Yes. It can assist in finding arithmetical errors. Yes. It is part of the double entry. No, trial balance is not part of a double entry system. It is useful in preparing financial statements. Yes, as soon as our ledger is done, as soon as our double entry is done, each item will be taken to the trial balance. And as soon as the trial balance is balanced, we prepare our financial statement, which means we prepare our income or statement of profit or loss and other comprehensive income, and we prepare our statement of financial position. So the trial balance helps us to detect errors. The trial balance helps us to it helps us to prepare the financial statement, and it's also a list of all items in the ledger, except it's a double entry. So the trial balance is not a double entry system. It only has a debit side and a credit side. And you know the items in the debit side, you know the items in the credit side.
Yeah.
Purchases on the debit side, return outward, return inward on the debit side, sales on the credit side, return outward on the credit side, provision for depreciation on the credit side, expenses on the debit side, income on the credit side, and assets on the debit side, liabilities on the credit side, drawings on the debit side, capital on the credit side, and so on.
Yeah.
I think that is clear.
Yes.
So that was question 9. We go to question 10. Which error is an error of original entry? They say a sale, it is A anyway. Sale of a surplus office equipment on credit to Janet for 230 entered 320 in both the disposal account and Janet's account, because we're going to prepare disposal account and Janet's account and we record it the same amount. So that is error of original entry.
Yeah.
So that's the first transaction, and we make the mistake in that transaction, both on the debit side and the credit side.
Yeah.
That's why I call it error of original entry. Is it clear?
Yes.
So the answer is
A.
A. Question 11. A check of $85 received from Shakil was credited to the account of Shams. Which journal entry corrects this error? Shakil paid a check of $85. So you are supposed to credit Shakil, but you credited Shams. So what are you supposed to do? Now you have to debit Shams and credit Shakil. Is it clear?
Yes.
The question comes from the back. So you will be thinking that Shakil received. Who received the check? The business received the check.
Yeah, okay.
Shakil paid the business the check. So that means Shakil should have the credit there, because you have to credit the giver and debit the receiver. But here you credited a wrong account. Do you understand? You credited a wrong account. That was what happened here. Do you understand?
Yeah.
Is it error of commission or error of omission?
Yes. Error of commission.
Error of what?
Commission.
Error of commission.
Commission is when you don't enter word.
No, commission means instead of Shams, you record charge, different class of accounts. Shams has his own account, Shakil has his own account. Instead of you to credit Shams, you debited Shakil. Instead of you to credit Shakil, you credited Shams.
Yeah.
The transaction is still fine. Your trial balance, this error will still balance your trial balance.
Yes.
It does not affect your trial balance because the error of commission. Is it clear?
Yes, sir.
So here, to correct this error, you have to credit Shakil and debit Shams. So the double entry is done.
Yeah.
Clear?
Yes.
So the answer for 11 is D. Question 12. The amount bank statement at 1 May 2021 showed a bank overdraft. A bank overdraft would mean a credit balance in your bank statement.
Huh? Yeah, credit
A debit balance, sorry, a debit balance in your bank statement,
and credit balance in the cash book.
in the cash book. Do you get it?
Yes, yes, yes.
A credit balance in your bank statement means a debit balance in your cash book.
It's the opposite, yeah.
Do you understand?
Yeah.
So an overdraft means you are having a debit balance in your bank statement. Do you get it? So having a debit balance in your bank statement means your account is on red. It's a negative balance.
So if the balance in the bank is in the debit, does it mean that they
If your bank statement has a credit balance, it means you are owing the bank.
if they have a credit balance?
Yes. If your bank statement,
Yeah.
if your business bank statement has a credit balance, it means you have an overdraft with the bank. Yes, it means you are owing the bank.
If they have a credit
If your bank statement has a credit balance,
okay,
it means you are owing the bank. That's an overdraft. That on your cash book, it will be on the debit side of your cash book. What I'm saying is this: your bank statement is having a credit balance.
Okay.
Your cash book,
having a debit. Yeah, debit.
Whatever you have on your cash book, the debit balance in your cash book is a credit for your bank statement. So if your bank statement is recording a debit, so if your bank statement is recording a debit balance, it means you are owing the bank. That's what I want to say. If your bank is owing, if you are owing your bank, you're going to have a debit balance. And that will reflect in the credit side of your cash book. If you are having a debit balance in your cash book, it means you are having a credit balance in your bank statement. I think it's clear now.
Yes, 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 yes.
It was a slip of tongue there. We're talking about your bank statement. For your bank statement, it needs to have a credit balance. That means you are not owing the bank. But if your bank statement is having a debit balance, it means you are on red. It means you have a negative balance.
Bank overdraft.
Yeah. So if you're having a negative balance, it will reflect in your cash book on the credit side of your cash book. So that means you're having that amount owed to the bank. So this is the situation here. So Jamal's bank statement is having a negative of 1,460. Clear?
Yes.
So now they said there is unpresented check. What do you do with unpresented check? You less it from that amount, because we call it unpresented check because the bank knows already. The bank has taken it away. It is still you that have not taken it away from you. So an unpresented check would be on the debit side of your cash book. Unpresented check will be on the debit side of your cash book because you will receive it back from the bank. The check has been dishonored. That's what. No, sorry, unpresented check.
You're gonna have it.
You're gonna no. You less it from your bank statement.
No.
The check has not been presented, but you have issued it. You have issued the check, right? Yeah. But it has not been presented to the bank. Yes or no?
Yes.
So you left it from the amount the bank is owing you. Did you get it?
Yeah, I get it.
All right. Then uncredited deposit. That means certain amount of money have been paid into your bank, but the bank has not credited you. You add it. Do you get it now? So you add uncredited deposit and you less unpresented check.
Yeah.
Do you know why you less unpresented check now? You less unpresented check from the amount the bank is owing you.
Yes,
because the check has been written. So in your cash book, it is done. It is a check that has been presented. You have issued the check. So you as a business, you would have deducted that amount. It will be on the credit side of your cash book.
Yeah, unpresented check.
Unpresented check will be on the credit side of your cash book. So that means you have to less it from your bank account.
Yeah.
Do you get it now?
Yes.
So the bank balance is minus 1,460 plus uncredited deposit, which has to be added to your bank statement, then unpresented check. So the total is 1,590.
Yeah.
Is it clear?
Yes. So then it's
yes. Question 13. What is included in a purchase ledger control account? Your purchase ledger control account only has goods returned to credit suppliers. Cash purchases is not going to be part of it. Debt written off as recoverable debt will be part of your expenses. Yes. Discount allowed? No. It's going to be your sales ledger. Yeah, discount allowed is in your sales. Yeah. Discount received to be your purchases ledger. Clear? Yeah. So the answer is D. Clear? Yes. Question 14. Javid's sales ledger control account had a debit balance of 12,000. Interest on an overdue account of $40 and discount allowed of 150 had been omitted. What was the correct balance on the sales ledger control account? So the balance, the income here is 12,000. Then there's an interest on overdue account. When you talk about interest on overdue account, that means we're talking about interest charged to your credit customers that did not pay the account on time. You know, you can get interest from them.
Yeah.
And that's another income to the business. So you add it to the income you have, which is 12,000 plus 40,000, plus $40. That is 12,040. Then you gave discount, which becomes an expenses for you as a business. So less discount allowed, which is an expenses. So you have 11,890.
Yeah.
Is it clear? So question 14 is B. Question 15. Which statement about capital expenditure are correct? When we talk about capital expenditure, it is money spent on day-to-day business, that is revenue expenditure. It is money spent on purchasing non-current assets, yes. It is recorded in the statement of financial position, yes. It includes expenses relating to non-current assets, no. So the answer is
C.
So it is 2 and 3. Question 15, C. Question 16. Nia sold equipment with a net NBV of 200. Yeah. The proceeds of the sale was 250. Which were credited to the sales account and debited in the cash book account. You are not supposed to credit it. Listen, when there is a disposal of assets, if it's a profit, you credit asset account, not sales account. Are you with me?
You credit
asset account, not sales account.
Oh yeah, because it's
disposal.
Yeah.
So if in this situation that you have credited sales account, you would have overstated your profit.
Sales.
Yeah, you overstate your profit
because
you are put certain amount of money that does not come with trading into it. So your profit has been overstated.
Yes.
So and your cash, the cash will also be overstated in your statement of financial position.
Yeah.
Do you understand? So yeah, I said that will overstate the gross profit as it is supposed to be credited in the asset account. That's the first mistake. If it was a loss, it will be debited in the asset account. It will have a debit entry if it was a loss. But it's a credit. It's a profit. It will be an income. That's why it is credited. I think it's clear.
Yes.
So cash will also be overstated because you've added cash into the account. So your statement for financial position, cash will also be overstated.
Yeah.
Do you understand it?
Yes.
The value is supposed to go to asset account for that equipment. Is it clear?
Yes.
So question 16, C. Question 17. Why does the business provide for depreciation on non-current assets? Provision for depreciation is made as it follows up with the machine concept.
Yeah,
so it's C. Question 18. A machine with an original cost of 10,000 has been depreciated for 2 years at the rate of 10% per annum using the straight line basis. It was then sold for cash with the loss on disposal amounting to 700. So for straight line method, the depreciation charge will be constant, will be fixed. Do you get my point? So the depreciation charge on 10,000, 10% of 10,000 is 1,000. So year 1 and year 2 is 1,000. So the accumulated depreciation for year 1 and 2 will be 2,000.
8,000 will be there.
Will be 2,000 accumulated depreciation.
Yeah.
Will be 2,000. Now the loss of asset was amounted to 700, right?
Okay.
So 10,000 minus 700 gives us 9,300. Do you get that?
Yes.
Then there's a new asset bought for 12,400. So 12,400 minus 9,300 plus accumulated depreciation will give you a final figure. It is 2 years.
Yeah, 2 years.
Accumulated depreciation is year 1 is 1,000, year 2 is 1,000, which is 2,000. Okay. So it will be 12,000 plus 2,000 minus 9,300, which is the value, the sales value of that asset. This is the value for the disposal.
Yeah.
So that's 5,100. 18B. Is it clear? You got it wrong, right?
Yeah.
Question 19. Why would a bakery business not issue a value for inventory of stationery in the statement of financial position? Oh, it is AS level. We did it in AS level. Why some business would not record certain figure in their statement of financial position? They wouldn't record it because the value is just too minimal. It's too small for them. That they can just bear it. They can pay for it even without recording it. Do you understand? The figure, if the figure is too small, You can't just open an item for that. You just ignore it. So that is what happens here. It was of very low value. So it does not have any impact. It's not going to have any impact in the business. That's why it's not recorded. Is it clear?
Yeah.
That's question 19. And question 20. Shilpa's financial year ends on 30th April. On 31st March 2021, she wrote off a debt owed by Tahir as irrecoverable debt. As soon as the irrecoverable debt account is open, you debit irrecoverable debt account and you credit Tahir's account as if Tahir is paying. Not if it was not bad debt written off. Tahir will pay for the account, yes or no?
Yeah.
So that means Tahir's account will be credited. Yes or no?
Yes, yes.
Then your bank or cash will be debited. But right now, it is a bad debt and it is irrecoverable debt. So debt that you have to pay.
Yeah.
So you have to debit irrecoverable. You have to open an account, which is irrecoverable debt. You have to open irrecoverable debt account, which has to be debited, and you credit Tahir's account. Yeah. Is it clear now? Yes. So that's question 20, which is
C.
Irrecoverable debt. Yes, C. Clear?
Yes. I'm gonna start with the.
Yes, start this.